Join me as I challenge myself investing $100,000 into the three best index funds that we have for retirement. And I'm going to show you exactly how it played out. Now, a couple years ago, we started investing on a regular basis. And the portfolio that we came up with years ago is the same one that we're using today that I recommend you do follow. It is kind of crazy, not financial advice, but it has worked incredibly well. And when we break down this portfolio, I'm going to show you. Now, when it comes to planning for retirement, when it comes to investing, making smart investment is crucial. It is really the number one game changer when you come and look at investments, especially looking at ETFs, because they have that super low cost ratio. Now, one of the most effective things to do is building wealth over time through investing in index funds, which is exactly what I did. Now, by investing in these ETFs or these exchange traded funds, it spreads the risk across the entire market like the S&P 500, which does incredibly well. Now, I do not buy bonds. I do not buy anything that is international, and that is by choice. When we start looking at the US market, it is about 50% of the global market. And when you start looking at the companies that are within that global market, when you think of Apple, Nvidia, Microsoft, Facebook, they are global companies in themselves, meaning they operate in a majority of countries around the world. And of course, the other challenge that we see, or the problem that we see, is a lot of people FOMO or they have the fear of missing out. And we also see people who do not go in when they should and actually pull out of the investment portfolio when they shouldn't. So they'll start seeing a couple red days. All of a sudden, they're all in. They are selling everything. Then, of course, when those red days are coming, that is the time you need to be dollar cost averaging in. That is the time you need to be putting a lot more money into these investment accounts. And really, when the market comes back, and it always has, you're going to be up tenfold, which is exactly what you're going to be seeing when it comes to the portfolio. Now, for me, we started this 3 years ago with dollar cost averaging. So let's hop over, take a look at this portfolio, and we'll break it down. All right, guys, so here we are with the 3 ETF portfolio. As you can see, this is our debt-free journey, just like we have right back here. And of course, if you like the content that we're putting out, definitely subscribe to the channel. Let me know in the comments what you guys think about the portfolio we built and how it has been really doing. So looking at here, this is through M1 Finance. Now, of course, there is a link down below. I have used M1 Finance for a multitude of years. And if you notice right here, this portfolio was actually started September 6, 2021. So to date, it is about 3 years, just shy of 3 years at this point. And you can also notice net cash flow, 95,000. So in the last 3 years, we have ranged about 32, what is that, about 32, a little less than 32,000 that we have put in here every single year. This is through dollar cost averaging. Like I said, when we start looking at the investment portfolio, every 2 weeks, we make contributions into this portfolio. If the market's green, we make our contributions. If the market is red, we make those exact same contributions. Now, you'll also notice right here, the money weighted return. That is right. We are up 78.98, almost 79% in this portfolio in the last 3 years. Now, the reason for this is if you think back to 2022, it was a very difficult year from the stock market. Tons of people cashed out, tons of people sold. Just like Warren Buffett has said, when there's blood in the streets, when it's red, it is time to buy. Everything that we bought in 2022 was, of course, discounted 10% off, 15%, 20%, 22% off. When it came to ETFs, they were on a big, big fire sale. Again, dollar cost averaging, putting money in there, regardless of what the market is doing, is what we're doing. And you can also see from the beginning where we started with nothing, all the way up through where we are sitting right now. Breaking out the last, or really the year to date. So we're looking at the last 9 months here. Year to date right now, we're almost at 18%. Now, when you think, again, the last 9 months, almost 10 months right here, we're up 18% in this portfolio. And then, of course, when you start looking at all of it, you can see out of the 95,000 we put in, the portfolio value is 121 right now, meaning we have a market gain of $26,000 in the last 3 years. Now, I know for a lot of people, that is real money. As when you start getting a portfolio and when you start hitting that 100,000 mark, that is the reason why Charlie Munger, that is the reason why Warren Buffett, that is the reason why most financial advisors say getting that first $100,000 invested is really the big, big part. Now, at this point, when you get into the 3 ETF portfolio, the snowball starts rolling. You start getting a lot more dividends, much larger dividends. Those dividends that you get are reinvested into this portfolio. So not only are you seeing the growth of the ETFs themselves, but you're also seeing the rebuy when it does come to the dividends, combined with dollar cost averaging that I'm still making contributions in here. Even looking here, dividends earned, we've earned $2,000. And again, for a lot of people, that's a pretty decent amount of money. Even though most of what you see in here, we do not have a really strong dividend presence in here. And I want to show you the exact reason why. So getting into the fund portfolio, breaking it down. So we start off with the QQQM. Now, as you can see, now we were not always invested into 3 ETFs. For a majority of this, we were invested into one and only one. That was the VOO. That was the Vanguard S&P 500, which is one of my absolutely favorite funds that we have within here. And even Warren Buffett have said, if you're looking to index invest, if you're looking at the S&P 500, putting it in there and just having one single ETF for a majority of people can work very well. Now looking at this, and I want to show you kind of the year to date that we have right now, want to make sure this is what we still kind of have turned on. So year to date, you can see the Vanguard, the S&P 500 is up over 20% year to date. That is a massive gain. Now, of course, looking back, it's very easy to see the gains. Doesn't really predict what could happen in the future markets, but overall that Vanguard, that S&P 500 is doing incredibly well. Now the QQQM is very heavy and it is based on the NASDAQ 100 versus that S&P 500. Now there are a lot of companies that do overlap, and the big thing with the NASDAQ, it is as focused on the tech. It takes out the financial industry. It takes out a couple different things that are not in that NASDAQ versus that S&P 500. So there is some overlap in here. I am not worried about overlap. I've talked about it. I've seen a multitude of financial advisors. Not really too worried about the overlap, because then, of course, we have the SCHD. Now, this is the Charles Schwab, the U.S. Dividend Equity. A lot of people do the VYM or the SCHD. There's a lot of different variances that you can come up with the portfolio. And personally, this is the one that I use. This is the one that I've used now for those last 3 years, and I will use going forward into retirement. Looking at this, it's very interesting because when you think of the market going down, when you look at the QQQM heavy tech, you're going to see a much higher or a much lower dip when it does go down. Same with the VOO, you'll see not as steep as a dip. And then, of course, the SCHD, which is companies that are large dividend payers. It is some of the most stable companies within the United States. So even when we see volatility in the market, the SCHD will stay pretty regulated, won't go down as much, won't go up as high as much, but it stays pretty regular within the market. Now you'll notice, guys, that 20% in that VOO, we're at 18% with the QQQM. Then, of course, we're at 15% with the SCHD. So even the very heavy dividend paying SCHD that we see right here, still doing incredibly well. And you'll notice there's a bunch of news in here. There's a bunch of stuff. When we go into the details of the SCHD, you can see it is a 3.35 dividend yield. Now, since the Federal Reserve has went ahead and pulled back a little, that 50% or 50 basis points that they pulled back rates, dividend yields and CD rates are going to start going away. So not only seeing that we're getting a pretty good dividend yield in here, and again, the dividends are being reinvested into this portfolio, just like we do with everything else. This is one that I highly advise. If you're looking for income, if you're looking for passive income, this has given me $544. And I believe at this point, we've been in it for 2 quarters. It's been 2 or 3 quarters that we've been into the SCHD. But again, thinking of the portfolio and looking big picture, when we start really taking this back a step, if you look at the VOO, now the VOO is one that I have held the entire life of this portfolio. So in the last 3 years through dollar cost averaging, we are up 72.85%. That's right, guys, 72% in 3 years. Crazy to think of the growth. Since we have picked up the SCHD, we're up 21%. QQQM is up almost 24%. And again, thinking of the government and really lowering those rates. What happens when they lower the rates? Of course, when they pull them back, it is cheaper to do business. So the cost of money actually goes down with those 50 basis points that it was lowered. With money being lower, it's cheaper for larger businesses to borrow money if they're looking to invest. And of course, with the artificial intelligence boom that's going on right now, AI is really big, meaning next year, when the Fed continues to lower interest rates, money is going to get cheaper. A lot of these larger companies are going to go parabolic. They are going to go much, much higher due to the fact that money is going to be cheaper. A lot more people, a lot more startups can borrow money to get off the ground. A lot more companies can invest in themselves because money is cheaper when interest rates are lower, meaning this portfolio in the next probably 3 to 5 years, we will have doubled our money, maybe even by the end of next year, within 4 years, because of course, rule of 7, doubling your money every 7 years, we could possibly see this portfolio even faster than 7 years go ahead and double, and it does very well. Now, the last thing that I want to look at and I want to show you is you'll notice the weights. So the target weights in here, the QQQM is at 40%, this is at 30, and then of course the VOO is at 30. So what I did was earlier when we were looking at this portfolio, kind of based on age, QQQM being at a lot heavier tech, still have 20 plus years to retirement. So thinking of that, thinking of the retirement age of 65, putting a little bit more and putting those percentages into that QQQM makes sense because we have another 20 years of growth. But what we're doing systematically is every so many years, let's say every 5 years, I will change the variance in here. That way, when we're making more contributions, it's going to auto adjust. We do not rebalance this portfolio at all. It will auto adjust manually based on the pies, based on the percentage. For instance, if I take this 40 right here, and then I move the Charles Schwab to 35, I may move this one to 35, through contributions, it's gonna automatically catch up to itself when I'm going in there. You'll notice on the left-hand side right there, it does show that it's overweight. This one's a little overweight, and then of course the bottom one is underweight, just based on the percentages. Contributions level this out in M1, which I wanted to understand and really show you guys how this does work. But this portfolio is doing incredibly well. And this is a portfolio where you can kind of set it and forget it. I'm not coming in here, I'm not checking it on a regular basis. We are letting this portfolio absolutely run as you see it today. In conclusion, investing in those index funds is a really smart play when it comes to retirement. Choosing the right funds like we've seen in that 3 ETF portfolio for long-term growth really increases your returns. I'm really making a very substantial nest egg in there. And then of course, starting early, being patient, investing on a regular basis is gonna make a big difference. Thank you for tuning in, guys. Let me know in the comments, what is your favorite index fund, which exactly, and how are you investing? And of course, if you're new here again, subscribe to the channel. We got a lot more that's coming, and I'll catch you guys in the next video.